I'm Marty Prince, and you're watching Ask a Mortgage Broker. Hello, I'm Marty Prince, and I've been a mortgage broker for over 30 years now. I've helped hundreds of people either buy or refinance properties, and I started this web series to answer your questions about the mortgage industry. So today, our question is from Brian in Glendale. He emails us, and he says, I want to buy an investment property and rent it out. Are the qualifications different for that type of property? It's a really good question, and yes, there are things about buying a property as an investor that you definitely need to know before you get started on the transaction. Probably the first thing that's important that you know is that you're going to have to come in with a considerable down payment to buy an investment property. Whereas a first-time home buyer, for instance, might put as little as 3% down to buy a property they're going to live in. As an investor, you have to be prepared to come with 15%, 20%, and sometimes even higher if you're going to be buying a property, for instance, a 2 to 4 unit type of property, that's even 25% down payment. So the down payment is number one factor you need to be aware of. So people sometimes come to me, they want to buy an investment property, and they think they're going to get into it with a small down payment. And so it does take considerable cash investment, 15 to 25% down payment. Secondly, the assets that you do bring in to do the down payment have to be your own money. You can't get a gift from a relative, for instance. The money has to be your money. You have to have had it seasoned into your accounts to prove that you didn't go borrow money for the down payment. It's your money, in other words, in your account. And also, on top of that, there's a little requirement where the lender wants to know that you have a little cushion so that if something happens in your finances, for instance, that you can still afford to make that ongoing payment on that investment property. So they want to see that you have 6 months worth of that payment in reserves after you buy the house. So if the monthly payment is $2,000, they want to see $12,000 or 6 months worth of payments in an account that's your money. They know you can take care of the payment if something happens. So those are the financial things that are different. Credit-wise, credit history, obviously the better your credit score, the better deal you're going to get. If your credit score is in the low 600s, for instance, you can still buy an investment property. However, going to be a little more expensive for you than if your credit score is above 700, for instance. So it's a really good idea to get your credit looked at. Make a plan to, if your credit is above 700, fantastic. If it's not, make a plan with a mortgage broker and take steps to actually increase your credit score, which will help you get a much less expensive kind of loan when you go to buy this investment property. Okay, another thing that's different about investment properties is how the lender figures out whether or not you monthly can afford to make that payment. The good news is that whatever rents are currently being collected on the property, or whatever rents are typical for that kind of property, which will be determined by an appraiser. So the appraiser is going to look at the market. He's going to say, this house should rent for $2,000. You get credit for $2,000 of income in the income side of your ledger. And then what the lender does is takes the debt for the house, what it's going to be. So let's say the debt is going to be $2,000 on the property. They're going to take your rent and give you 75% of your rent. So in this case, your $2,000 in rent becomes $1,500, for instance, which is 75%. And now the difference between what you're going to pay for that house, which is $2,000 a month, and the $1,500 in rent that you have now becomes $500, for instance, and they call that a negative cash flow on your property. That debt is now counted against you and you're qualifying. So they don't count the full $2,000 payment against you. They count the difference between what the income is on the property, adjusted to 75%, and what the payment is, and that payment now becomes a monthly payment that you have to then be able to afford. So they add that payment to your debts, and as long, again, as your ratio is in this basic 2 to 1 kind of a ratio, income to debts, then you're going to qualify for that property. A mortgage broker, again, can help you to go over all those numbers and figure out, okay, the particular property you're looking at, what's the rent on it, what's the mortgage payment going to be, how much are they going to count against you for that property, and then you can see simply whether you qualify for it or don't. Simple little process. So those are the main points for you to be aware of as an investor in getting involved in an investment property. And I hope that's answered your question. Again, if you or someone you know has a question relating to anything in the mortgage industry, please email me at mprince@socal.rr.com or send it to us via our Facebook page so we can feature it in a future episode. And be sure to give a thumbs up and subscribe if you like what you saw. And as always, thanks for watching.